I'll echo my colleagues that I really appreciate being put on the panel, and I commend the organizers for putting on a really good conference and thank the central bank for hosting it. So this, I guess I should start by saying any views I say may or may not reflect the views of the Chicago Fed or the Federal Reserve System. And this is work with my colleagues at the Chicago Fed. One of, where's Charlie? Jeff is over there. So this paper is about the communication by a central bank of its future policy. So that's forward guidance. In the US, the Fed has used forward guidance in its post-meeting statements since the late 1990s, when it started using the language balance of risks, which was understood to signal the direction of future rate movements. During the Great Recession and recovery, forward guidance became one of the primary tools for monetary policy as the policy rate was constrained by the ZLB. When the Fed funds rate was initially set to near zero at the end of 2008, the post-meeting statement signaled rates would stay exceptionally low for some time. Soon after that, some time became extended period. In 2011, calendar-based guidance was introduced when the Fed signaled it would keep rates exceptionally low at least through mid-2013. There remains debate about the efficacy of forward guidance, but from the perspective of the canonical model used to study monetary policy, the new Keynesian model, the economic outcomes that we observed appear puzzling. In the new Keynesian model, forward guidance signaling the extension of a low interest rate peg will have ever larger effects as the length of the peg is extended. That these effects did not materialize has come to be known as the forward guidance puzzle. The forward guidance puzzle has spawned a large literature that has explored numerous mechanisms to mute the effects of forward guidance in the new Keynesian model. However, this literature has ignored the ultimate source of the puzzle, that the central bank has perfect control over private sector beliefs about the future path of monetary policy. In this paper, we relax this assumption and explore the empirical implications of doing so. We develop a new modeling framework of imperfect central bank communications, and the modeling framework is very simple. The central bank sends noisy signals about its future intentions, in particular, its intentions to deviate from its Taylor rule, say. These noisy signals, the noise in these signals reflects two key challenges in communication, at least in our minds, two key challenges. One is lack of clarity. So as we've been talking about at this conference, the words used by the central bank may confuse the public. So that introduces noise into the communications. There's also lack of credibility. So simply, the central bank just doesn't know what it might want to do or how it might want to deviate from its Taylor rule in the future. Think of deviations perhaps as risk management. There isn't a risk in the Taylor rule, but there may be times in which the Fed or the central bank may want to shade policy one way or the other, and circumstances may change. It just won't be doing what it might have thought it would do in the first place. So we take this modeling framework and we embed this imperfect communication framework into an empirical new Keynesian model, a medium-scale new Keynesian model. We're going to estimate this model using a large data set, and what's really important about this data set is that it includes federal funds rate futures, expectations in the market of future federal funds rates. We're going to take this estimated model and ask two questions. Has the Fed communicated clearly and credibly? And if not, what are the consequences of those failures in communication? Let me summarize the main findings. First of all, it's seemingly hard. What we're going to find is it's seemingly hard for the Fed to move expectations at long horizons. This suggests that the forward guidance puzzle is not empirically relevant. We also find that imperfect communications influences shock propagation. So the effects of forward guidance are delayed with imperfect communications compared to perfect communications, and you can see greater amplitude in some circumstances. While imperfect, forward guidance brings forward the effects of policy. So that's our third key finding. So in principle, it remains a valid tool for stabilization even though communications are imperfect. Finally, we find that unintended communications spur sizable macro volatility. So if there's a lot of noise, that can lead to volatility.
Can you please...
Oh, am I too far from that? I'm sorry. So let me get right to it. The equation up here is a familiar equation. It's the Taylor rule, if you will, a policy rule that relates the policy rate to the lag policy rate, inflation gap, and the output gap. In our model of communications, we're going to assume, and GT is the rule. It's allowed to change over time. Our model of communications is going to suppose that the rule has been communicated already. There's no doubt about the rule. Everyone understands what the Fed's doing and what it has done. In addition, we're going to assume that people observe the output gap and the inflation gap, whatever the gaps that the Fed uses in its policy. Where communications come in is with the deviations of policy from the rule. So forward guidance in our framework is going to consist of the Fed sending out a vector of noisy signals about future deviations. In particular, this is a vector S of signals that includes the actual deviations that will transpire. So this is a vector running up to theta t plus capital H. And then VT here is the noise. Let me spend a little bit of time talking about how we think about these policy deviations. So in normal times, the way we think about theta t in normal times, that is away from the ZLB, we think of theta t as playing a risk management role. So in our data, the federal funds rate has, if the Fed is conducting policy in a risk management manner, the data will reflect that. In our model, it'll be a linearized model. There isn't any risk in the model. Agents aren't actually directly affected by it, and it doesn't appear in the rule. So deviations from the rule would show up as risk management. The other way to think about theta t is, or these deviations, is the way we've come used to, is policy at the ZLB. So either it reflects the fact that you're forced to deviate from the rule because the rule says that you'll be below zero and there's a zero lower bound, but it also could take into account the policy, the Woodford-Krugman policy of lower for longer. So that's how we think about the theta t, and the noise is what I mentioned before. It's capturing these challenges in communication. So perfect communication would have noise with zero variance. In fact, we make some assumptions here about the actual deviations in the noise. We're going to allow the actual deviations to be serially correlated up to H lags, and that partly does reflect the fact that you'll see correlation across the term structure of federal funds futures at a point in time. Changes in the futures path will be correlated across the term structure. So it's important to allow the thetas to be correlated too. The noise is IID with a variance covariance matrix that allows for correlation there too. Okay. So in this environment, agents this is a very standard rational expectations environment, and it's optimal for agents to use the signals and the Kalman filter to update their beliefs about future policy deviations. So here it's very simple. The expected how do agents update their beliefs? They update their beliefs using the Kalman gain multiplied by the signal less what the expectation was in the previous period. That's just a simple learning process that's optimal in this environment. And the Kalman gain, the factor that is used to update beliefs, depends on the variance-covariance matrix of the actual deviations and the variance-covariance matrix of the noise. One nice feature of the way we set this up is because of the policy deviations can only be communicated for a fixed lag length, h, this variance-covariance matrix is stationary over time. So that makes things quite, helps us a lot. So we're going to embed this communications into a very standard medium-scale DSGE model. There's the New Keynesian DSGE model. The model is familiar in all dimensions. There's a representative household that cares about consumption and leisure. There's sticky wages and prices introduced in the usual way. There's investment adjustment costs, variable capital utilization, balanced growth driven by neutral and investment-specific technology. We've got a monetary policy rule and a bunch of shocks. The only difference is the communications and learning. So we're working in a very, very standard framework, and we're using that framework to assess the communications issues I mentioned. We're going to estimate the model with a large number of quantity and price series. That's one of the features of our approach that we like a lot. So we have multiple wage and price measures to identify the wage and price Phillips curve. We'll be using the federal funds rate and the overnight interest rate futures. And I want to emphasize the futures rates are really important. We're going to work with a linearized model, and so in principle you think, well, what about the ZLB? Well, in our estimation, we're going to force the model to match the futures path. So expected future interest rates in the model have to correspond to the market rates, and the market rates never went below zero. So in that way, we address the ZLB, and it's obviously important. The forward guidance is all about these movements in the expected policy path. So it's essential for identifying forward guidance. One other thing I'll say about the estimation is that we estimated over a period 1993 through 2016, but we break the sample in 2008. There are a couple of reasons why we break the sample. One is it's kind of obvious that forward guidance, at least the futures market, priced in forward guidance over a longer horizon than before the financial crisis. So we allow for there to be a change in forward guidance from 4 quarters ahead to 10 quarters ahead. That's one change. The other is there's plenty of evidence that the natural rate of interest and potential growth have changed. So we're going to imagine in 2008 Q4 that there was an anticipated and unanticipated and permanent change in those two objects. So we're going to take this model and we're going to use it to study. We estimate the model, and from the estimated model we can obtain the variance-covariance matrix of policy deviations and the variance-covariance matrix of noise, and from that we can calculate the Kalman gain matrix, and from there we're off to the races in analyzing policy. We're going to do so. In the paper we do it in a variety of ways, but well, in this context, 2 ways. But I'm going to focus on one today. We consider the following experiment. At a point in time, you receive a vector of signals. In this case, this is our first sample, so there are 4 quarters ahead. So that these are signals of what the deviations from the policy rule, 1, 2, 3, and 4 quarters ahead. Imagine that we give those signals to agents sequentially. So we give them the 4 quarter ahead signal, and then we add to that the 3 quarter ahead signal, and we add to that 2 and the 1. What this plot shows is the reduction in uncertainty in a way that's laid out precisely in the paper due to the addition of each signal. So 1 here indicates the first signal. That's the one that's 4 quarters ahead. And this will be the one that's 4 quarters ahead and the one that's 3 quarters ahead, and then all the way to the next period, and then 2 periods ahead and then 1 period ahead. So the point of this picture, or rather the outcome of doing this exercise, is that just knowing about the 4 quarter ahead, being given the signal about the 4 quarter ahead policy deviation, does virtually nothing to reduce uncertainty about the policy path. So that 4 quarter ahead guidance, so to speak, about policy deviations does nothing, virtually nothing to change the uncertainty about the path. And even up to giving them 3 signals, so 2 periods ahead, 3 periods ahead, 4 periods ahead, you still have a lot of uncertainty. Only 20% of the uncertainty is reduced. 1 here would be perfectly revealing. When you have all 4 of those signals, there's still a lot of uncertainty remaining about what the path is. So this is a sense in which it's certainly here that assuming that the Fed has perfect control over policy expectations is for an arbitrary horizon seems questionable. Oops. Let's go to the ZLB period. The ZLB period, and the period 2008 Q4 to the end of our sample 2016 Q4. Here we have 10 signals about the future path. So when and it's the same experiment here. So we've got a vector of signals at a point in time, and we're going to look at the 10 period ahead one, and then we'll add both the 10 and the 9th period ahead, etc. So what this says is that essentially there's a tiny little line there, so there is a microscopic reduction in uncertainty, but essentially that 10 periods ahead gives you telling agents, the signals that we've estimated and the variance covariance matrices we've estimated say that giving a signal about what the funds rate will be 10 quarters ahead conveys virtually no information. And even adding these signals here, it's still a very little information. You do, what is that, 1, 2, 3, 4, 5, 6, 7, about 2 years ahead, that information starts becoming valuable. Now, once you give them all 10 signals, you've reduced uncertainty a lot. And a lot of this comes through the correlation, this does come through the correlation structure of the variance covariance matrix of the signals. Now, one obvious question is why these numbers are so low and these are relatively high. We throw out a couple of ideas in the paper. One I'll emphasize now. It's probably not the only way to explain this, but and it's come up in conversations and discussion here, is that when something really big and important happens, like a financial crisis, you might pay more attention to what the central bank is doing. And our model of central bank learning has a connection to a world in which paying more attention reduces uncertainty. The next thing, the final set of experiments I'm going to talk about now, it'll take a while to set this up. We're going to consider the dynamic response of the economy to a forward guidance shock. For the moment, just focus over here. There's a lot on this page. Focus on this over here. So we're going to consider a hypothetical forward guidance shock, which is a disturbance that leads to signals, these stars, no change in the policy rate today, but or rather no deviation from the policy rate today, but policy deviations going forward. Imagine a world in which these are in fact actual deviations that will occur, and consider 2 cases. One in which these signals are perfectly revealing, and everyone understands that. And another case in which we use our estimate, so that's in our setup, that would be having an identity matrix for the common gain. Then consider the alternative, the imperfect communication that we've estimated, so the common gain that we've estimated. The black lines here are how how expectations of the future deviations evolve over time as the signals, as it's the same path of signals, we're going to, and these, as I said, they're truthfully, this is exactly what the deviations will be. So over time, you see, initially, after the initial announcement here, expectations don't budge at all. Here, they start budging. Two periods go by. Eventually, you do see movement towards the path, but it takes time. Now let's take so this is how expectations of the future deviations evolve over time. Now let's see what the response of the economy is to this shock. So this picture has a fair amount in it. Ignore the blue and the yellow for now, please. The stars here correspond to the response of the economy to this forward guidance shock when these policy deviations are perfectly communicated. The black line corresponds to the imperfect communication case. So these stars and black lines correspond to the ones apply from this case. So the slow learning is built in here. So what you see is that the imperfect communication delays the response the response of ours in this particular case to the forward guidance shock relative to the perfect communication case, and there's a little bit of amplification here. So I mentioned that before. Now let's think about the blue and the yellow. This is a particularly informative decomposition. The blue and it's exact decomposition of the response of the black line. The blue is the case where the central bank chooses not to communicate at all. It's just pure monetary surprises. The deviations, though the red stars in the previous plot of those deviations will happen and do happen, but no signals are sent about them. So they're pure surprises. The yellow corresponds to the case where signals are sent, but nothing happens. So you send the signals, you send the signals corresponding to these stars, but in this decomposition, nothing. The deviation is in fact zero. So what this shows you, what's nice about this decomposition is the yellow will tell you essentially the expectations channel of forward guidance, and how forward guidance is helpful in if you want to say provide a buffer against inflation, so you want to put a drag down on activity. Forward guidance is helpful. It brings forward the effects relative to the blue. But the other thing that the yellow indicates is the role of miscommunication and noise. So remember, in the yellow cases where the signals are sent, but they are pure noise. So what you're getting here is volatility from bad communication, or imperfect, imperfect communication. So I'll sum up. So what we do in the paper is that we develop this empirical model to study central bank communication. We find that imperfect communication limits the ability of the Fed to affect beliefs, and it does so in a way that we think challenges the empirical relevance of the forward guidance puzzle. The forward guidance puzzle remains or rather the strong effects of forward guidance in a world with perfect communication are still there, but it's not important from an empirical perspective once you take into account imperfect communication. And then, as I just shown, while imperfect, forward guidance does pull forward the effects of policy deviations, and that can be helpful as a policy tool. And so we don't want our results interpreted as imperfect communication. Invalidates forward guidance as a monitoring policy tool. And finally, and this is the point about the yellow bars in the previous slide, unintended communications spur macroeconomic volatility. Thank you.
Thank you, Jonas, for your presentation. So I invite Michał Brzoza-Brzezina, a discussant of the paper from the Narodowy Bank Polski. Welcome.
Hello, good afternoon, everybody. So my name is Michał Brzoza-Brzezina. Thanks for having me here and for giving me the opportunity to read the paper, go through the codes. Before I have the presentation, maybe I say the authors were super kind. They sent us all the codes, all the data, so it was a great pleasure to go through all the codes. It would be even more pleasure to have my slides on. Okay, let me start without slides. So what's the motivation for the paper, okay? So the motivation for the paper, at least the way we think about it, maybe it was a little bit differently presented by Jonas, is that, forward guidance has been used by several central banks. It seems to work in practice, but it doesn't seem to work miracles. While if you take into account the more standard tool that we use to analyze monetary policy, which is the new Keynesian model, then in this model, the forward guidance works like magic. And let me give you one example from a paper that probably many of you know. It's Marco Del Negro's and co-author's paper called The Forward Guidance Puzzle. So what you have here, look at this bottom part. You have the impact on output of monetary policy shocks. In the first column, it's expansionary current period monetary policy shock. Okay, so today the central bank lowers interest rates, output goes up as usual, nothing special. In the second column, you have just a promise from the central bank side to lower interest rates in 1 year ahead, in 4 quarters, and you see output expands by more than from the original shock. And the last column is a promise to do something in 8 quarters time. And even more. So that's what Jonas said. That's sort of surprising, and probably nobody believes it, actually. The source of the trouble, if you try to sort of find one culprit, is the Euler equation. The Euler equation tells you that output ultimately depends on the whole series of real interest rates from today until infinity, expected real interest rates from today until infinity. So even if you promise some reduction of real interest rates 100 years ahead, it still has an impact on output today, which, doesn't probably make much sense. People have tried to fight this effect. So, for instance, Marco Del Negro, they test whether introducing the probability that people die would help here. Of course, it helps because you ignore things that will happen after 100 and 200 years. But to have sizable effects on this forward guidance puzzle, probability of death should be enormously high. So, like, I don't know, 10 people from this room being dead by the end of this year, which nobody would like to, and hopefully will not happen. Okay, so we look for other means to fight this puzzle, and here's the paper. Here comes the paper. Central bank promises are not fully credible. That's the idea that Jonas and co-author try to bring to us. I know you have seen these equations. Still, maybe for the second time, doesn't matter that much. So what's the idea? How is it implemented? It's implemented the following way. The central bank sends a signal. Theta is a vector of deviations from the policy rules, okay, for today and a number of periods into the future. Central bank, instead of saying perfectly what theta is, they just send a signal S, which is noisy, okay? It consists of theta, but it also consists of V, which is just pure noise, some random shocks that disturb the signal, okay? Agents are not interested in V, they are interested in theta, so they try to separate noise from signal. Model is linear, noise, the noise is Gaussian, which means that the optimal way to do it is to use the Kalman filter, and that's exactly they do. And that's the crucial equation that explains everything in the model, which says that expectations, what people think about theta today, depends on what they thought about theta yesterday, plus a correction due to the signal, but the signal is pre-multiplied by kappa. What is kappa? Kappa is the Kalman gain matrix. And the Kalman gain matrix actually is crucial here. It explains everything. I'm a great fan of explaining everything via kappa. You will see it. So where can we get kappa from? Well, we can estimate the model. We don't know how to estimate Jonas didn't talk about it, but we don't know how to estimate the model with imperfect information, the original, the true model. But there is a theorem that tells us, well, you can estimate a similar model with perfect information. It's called news representation, and then there's a mapping from this one to the original model, very simple mapping. So that's what's exactly done in the paper. And from the perspective of this estimated model, kappa depends on the variance-covariance matrix of news shocks about current and future monetary policy. So of the shocks that the central bank does or promises into the future. I don't want to bring you more into the analytics of this, but let me just give you two examples how these shocks affect kappa, okay? Because that's crucial to understand. So imagine a world when the central bank makes this news shock about policy, I don't know, 1 quarter ahead, 2 quarters ahead, 10 quarters ahead, whatever. And always when they do this shock and they say, well, next quarter I'm gonna make policy more expansionary or more contractionary, in fact, when this quarter arrives, it delivers, okay? So the bank does exactly what it promised 1, 2, or 3 quarters before. In this case, after the estimation, kappa will be just an identity matrix, okay? Just ones on the main diagonal, zeros elsewhere. And if you go back to this, what I call the crucial equation, and you substitute one, or identity matrix to be precise, is the matrix stuff, over here, that boils down to something very simple, which is expectations of theta just equal the signal, okay? The central bank is perfectly credible in this case. People know what they promise they always deliver. So if they send a signal, people believe it, and well, that's what this equation summarizes, okay? In the more general case, if the central bank does not always, or in particular never delivers what it promises, kappa will differ from the identity matrix, and as a result we will have a partial, or even in the worst case, zero credibility of what the central bank says. So ultimately what kappa is depends on what the model says, what the model sees, in the data, how the central bank promised something, and delivered. Yeah, that's where kappa comes from. Okay, let me skip the analytics. Let me show you what I mean on a picture that's sort of we derive. So I'm gonna show you a number of simulations. Most of them they will come from a different model. Okay, so let me make it clear. Jonas and co have a fully fledged DSG model. We have a basic toy free equation Euclidean model, okay, but the idea is the same, and the idea of forward guidance in this model is also the same as there. And hope you can see these three lines. So that's the reaction of the output gap to a forward guidance shocks one period ahead. So as simple as that. So the central bank in period 1, which is just the beginning of the slide, says next period I'm gonna lower interest rates, okay? And the important question is, how do people react to this, okay? So what's the reaction of output today? And the red line, so the highest line over here, is the case of full credibility, okay? So the Kalman gain matrix is 1, identity. The central bank is fully credible, and you see output jumps immediately already today due to this news about monetary policy being expansionary tomorrow. So we are sort of back to the forward guidance puzzle case, yeah? The second extreme is the blue line. That's zero credibility. Okay, so Kalman gain is zeros, but for one entry, which means that people don't believe the signal at all. Only when it happens, something happens. But initially, when the signal is released, output doesn't react at all. Okay, and somewhere in the middle, that I think that was supposed to be orange, there is a simulation at 50% credibility, and you see that output reacts somewhere in the middle between these two extremes. So that's hope I explained on a different example how I think the model works. So what does the paper show? Ultimately, there's a fully fledged Bayesian estimation of the model. And this estimation shows that the Kalman gain is sharply decreasing with the horizon. Okay, so the further out, the less credible is the central bank. And you've seen this picture. Okay, so that's essentially what it shows is that 10 periods ahead, central bank promises something, but people, that's the black line, don't believe it. Only over time, as time passes and the central bank repeats and repeats the signal, does the black line catch up with the red stars, okay? Why do I like this paper? And I must say I like it very much. I think it's a very novel and very smart approach to handle the forward guidance puzzle. And I'm very impressed by the estimation. It's very well disciplined, especially using these forward rates to discipline news shocks. I think that's really very, very important. Still, I have some concerns. I hope I prepared 2 concerns and the long list of extras, which I probably won't be able to cover, but leave it to the author. So let me talk about these 2 concerns. So the first one is the role of the zero lower bound. Jonas said, well, we know there is a zero lower bound, but interest rates, at least part of the forward rates, are not subject to this. Okay, I still believe this assumption about the zero lower bound not being binding in the model is not so innocent. So what did we do? We did a simulation. We took our free equation model, okay, assumed the economy being subject to zero lower bound, driven by 2 types of shock, demand shocks, which just drive it to the zero lower bound from time to time, and forward guidance shocks. So there's only 1 period ahead forward guidance shocks driving the model. We simulate data from this model with the zero lower bound being hit from time to time, and then we take the data and bring it into a model where we ignore the zero lower bound. Okay, so like the model that's estimated in the paper, and we estimate the wrong model with the data from the true models. We estimate the variance of demand, monetary policy shock, forward guidance shocks. We filter the shock series. We do all the standard stuff that you do after the estimation. And here is what you get. So let me start with the left-hand panel. That's the interest rate. Okay, so that's just part of our simulation. You see the interest rate fluctuates, and twice in this part hits the zero lower bound for a few periods here between 40, 50, and between 60 and 80. Okay. On the next slides, what I show in the next slides are 2 lines, red and blue. The red line is the true model. The blue line is what we estimate from the wrong model. Okay. So in the red line, there's no current period monetary policy shock. So the red line is just flat over here. But probably not very surprisingly, we get from the estimation from the wrong model, we get some monetary policy shocks, current period monetary policy shocks being filtered. On this panel, you have these news shocks. There were news shocks in the original model. So you see the red line fluctuates around. But in particular, at moments where you hit the zero lower bound, you see that the blue line deviates quite sharply from the red line. And we also filter the signals that the central bank sends out, and you see that they do differ as well between these 2 frameworks. Furthermore, we can calculate the Kalman gain. Okay, so in the original model was a model of perfect information, of perfect communication. Okay, so the Kalman gain matrix in the original model was just an identity matrix. Okay, what the central bank promised, it always delivered, and as a result, it's imposed, but you could also estimate this. It's just an identity matrix. However, once we estimate the wrong model, unfortunately, this matrix stops being an identity matrix. You see, here's 0.2024. Here's something different than 0. So the question is ultimately, okay, it's just a matrix. Does it matter? Doesn't it matter? And I have to repeat at this point what I said before. That exercise is from a different model than Jonas had, and it's a sort of stylized simulation. So I think it's fair to say that this problem is almost for sure to apply to their model as well in a qualitative sense. I don't want to claim that the quantitative sense that I show you here applies to the paper that I discussed. Right? No idea about it. I think could be hard to check anyway. But we don't know how to estimate big models with. We don't know how to estimate models with ZLB, particular big models. Okay, but to check in our model whether it matters. We run the same experiment as before, so we just run the forward guidance shock. Okay, in the true model, and that's the red line. We had perfect credibility, and that's the reaction of output again. Okay, we had perfect credibility, so output reacts immediately. Okay, so in the true model there is the forward guidance puzzle. Here's the reaction in the after estimating true data on the wrong model. Almost no reaction on impact. Okay, only after the shock hits actually there is a reaction. So I think that there could be a problem here. And the last, just one slide. But my second concern, probably somewhat related to it. So as I said, we got the model, we got the code, we got the data. We tried to use the data. I hope we did it correctly to recover the signals. So we didn't get the signals, but we tried to calculate the signals from the data that we got. Hope we did it correctly. If not, I still believe the authors should do this exercise. I'm in a much better position to do it correctly for 100%. But if we are correct, then this is what you get. So the blue line, that's from their model now. It's okay. Forget about our model. It's from their model. It's just a sample. So the blue line is the signal that the central bank sends about policy today, while the red line is the signal that the central bank, the Fed, was supposed to send about policy today, yesterday. Okay, they do differ, obviously. You would expect some consistency in communication. Okay, so what you do today should be somewhat related to what you promised yesterday and 2 periods and so on. And if you calculate the correlation of these, doesn't look like, but there is some correlation. So the correlation between these two signals is actually almost 0.4. Okay, not much, but okay, it's positive. It's not zero. But if you go back in time, so if you calculate the correlation of the signal released 2 periods ago about the policy today with the policy today, and 3 periods ago and 4 periods ago, you see the correlations, at least in what we calculated, go down to zero. So that looks like the Fed communication. The question is, was the Fed communication really so noisy or inconsistent or unpredictable? I don't know how to call it, but I can't believe the Fed was that noisy. Okay, all right. So let me conclude. I really love the paper. I love the approach. I never learned a lot from reading that much from reading a paper like this time. So we spent two weeks going through the codes and trying to understand what's going on there. The major doubt is that the estimation procedure does not completely well identify Fed communication. And in particular, this doubt, the direction in which this doubt goes, or the conclusion is that, in my opinion, the findings can be maybe too pessimistic for the Fed. Okay, so that in practice, Fed communication is more consistent over time than what comes out from this paper. Okay, thank you.
Thank you, Michał. So we'll give you a few minutes to respond. Yeah. So we are running out of time, so I guess you have to speed up a little bit.
Can I get the slides back? Can I get the discussant slide back?
Discussant?
Yes. I want to pull up the slide. So I want to thank Michał. He sent me the slides in advance, so that's, I think, a great practice of a discussant. So I knew what was coming. No, that's my slides. I want the slides of the discussant, please. So the point I want to address is the identification of the shocks, and Michał raised a potentially damning point. He simulated a model where there was where with and without imposing the ZLB, and okay. So it was this plot that makes it look like we might be misidentifying our shocks. It's really central to everything we do is that we have these expected future rates. What's important about that is that agents inside the model, when they look forward, they see that they don't see the ZLB being violated. That's essential. I believe, I believe that in this experiment, what will happen by ignoring the ZLB is that sitting at this point, agents in this counterfactual case will look forward and they will see, because you didn't use futures rates here, right? They will see the interest rate go negative. So I think the reason why you see this difference here is precisely because agents in this alternative scenario aren't given the futures rates. If they were given the futures rates, in my assessment, you would essentially get this back. You would correctly get the red. That's my view. Yeah.
So in your model, you model consumers, but here what you are using to estimate it, we have financial market participants. Have you thought about it might be getting interest rate expectations from surveys? Because your co-author on the paper last week was proposing maybe instead of Hank-type models or Tank, we should have Shank models, stupid, heterogeneous agent, Keynesian models. Maybe there are agents that are not forward-looking, and there seems to be evidence that limited cognitive abilities might matter for expectations formation. So have you thought about, it's totally, I think, plausible if you would model financial market participants. You could say, well, you know, I have my interest rate futures, long dated, and that all works fine. But it's not clear to me that actually for individual consumers that statement saves you in that respect.
So the study of heterogeneous agent models and beliefs that may not correspond to what financial market participants think is an excellent thing to study. Our point here was that in this basic setup that people use to study forward guidance, people have run off to consider all these other modeling strategies, and our point here is, well, if you step back and just ask the basic communication question, the topic of this conference, this forward guidance puzzle that comes up, it really isn't there. Now, there are other factors that heterogeneous agents, and those could be important too. We just wanted to make the point about the communication.
Okay, thank you very much. Unfortunately, we have to move to the second presentation since we are running out of time. So I want to introduce our second speaker, Michael Weber from University of Chicago, and with his presentation, Monetary Policy Communication, Policy Slope, and Stock Market. So we are really looking forward to hear what is policy slope. Michael, please.
Let's see. Okay, so actually after Jonas gave this super interesting talk, I actually realized that two things are missing on the first slide. The first one is the disclaimer that those are my views and not necessarily the views of my co-authors, and given that I did actually not have Emanuel's slides beforehand, they are my current views and might not correspond to my future views about my own paper anymore. So what we are trying to do, if you think about the Fed under its dual mandate, they try, besides providing price stability, also directly affecting real consumption, real investments, and real GDP. But actually, while in the data, if you look at those real quantities, monetary policy only has a rather indirect and somewhat delayed effect. You see immediately when people open their mouth and say whatever it takes, there's a strong, very immediate response in financial markets, which then had actually led to this very large literature by now using the response of financial market instruments to FOMC announcements. And so, for example, think about Kuttner surprises. You run a high-frequency event study, like Sachs-Swanson. You see, indeed, actually, there's this very strong response of financial markets to those monetary policy surprises. But actually, if you think about it, those FOMC high-frequency event studies, typically you have 8 scheduled meetings a year. And then if you look at the shocks, most of those shocks are tiny, which just tells you that most of the policy decisions are actually not only coming out in this half-an-hour window maybe around FOMC meetings, but actually policy happens rather continuously. And on the other hand, actually, if you think about the fact that we typically only would look at, until recently at least, there are now a few very notable exceptions, also Jonathan Wright and others have looked at it, but the classical event study literature, Bernanke, Kuttner, GSS, they would actually typically look at short rate shocks at the very short end, a la Kuttner, but actually then of course, you know, what matters for the broader economy, but also for financial markets, is not only actually what happens at the very short end, but potentially the whole future path of monetary policy. We're obviously not the first ones who have noted that. I just have here two representative quotes from two policymakers. On the one hand, Janet Yellen made exactly that point before the liftoff. You know, now everyone is speculating when actually we leave the CLB, but in the end, actually, we shouldn't overestimate that because, again, what matters is actually not only the timing, but the whole path. And at the same time, former Governor Walsh actually said policy deliberations happen on a rather continuous basis. And that's pretty much the background against which we want to now understand how financial markets respond to what we call the policy slope factor. What we mean by that is we want to now understand or construct an animal that tells me something about the future path of policy and orthogonalize that with respect to what happens at the short end to policy, my usual Kuttner surprise. And then at the same time, we also want to not only understand that in event studies, but also potentially throughout the year. And so the way we want to do that is now actually use the change in the long-dated future, and then just actually regress it on the change in the short-dated future. Short-dated future, if we now actually move up interest rates at the short end, this will have a level effect on all future rates, so therefore orthogonalizing it, we get rid of this level effect and then only look at what happens in the long end relative to the short end, and that's ultimately what we call a slope factor. Ideally, we would actually want to use the longest possible Fed funds futures. If you read Rayford Gökernat's work and co-authors, they actually show convincingly that until the mid-90s, so pretty much the only thing that was liquid was the 3-month futures, and actually in fact until the end of the 90s, the longest dated futures we had were 6- and 9-month futures. So whenever I now talk about long-dated futures, I'll mainly mean 3-month futures. It's maybe not as long as we would like, but doing it this way, we can actually start as early as possible. Now we actually construct this slope factor by looking at weekly changes in the 3-month futures, orthogonalize it to weekly changes in the 1-month future and take the residual. That's what our slope factor is. Then you actually would use the slope factor and your standard predictive regression, look at next week's excess return on a broad stock market index, regress it on this week's slope factor. You see actually slope predictively, robustly predicts lower returns going forward. So a way to think about it, higher than expected rates in the future relative to current rates or faster expectations of faster tightening signal lower stock market returns going forward. You see actually that's a pretty robust finding, and in economic terms an investor would actually exploit this predictability could increase his or her Sharpe ratios by about 20 percentage points. We argue actually the slope factor signals information about future interest rate changes, which you indeed see in the data. You can predict future Fed funds rate changes. And we also argue that actually it's monetary policy communication coming out throughout the week, which might actually then shape expectations of long-dated futures. We show indeed, using some simple linguistic analysis, that speeches by policymakers can explain up to 12 percentage points of the variation in slope. And remember, slope is a regression residual, so we think that's actually quite sizable. And we also try to convince you actually that what we are finding is news about policy rather than just maybe capturing macro news. So if we would use standard macro surprises, it doesn't look like it can explain the variation we uncover for stock returns. And finally, I think that's also important. So we argue actually that the Fed is maybe communicating information and then financial markets react to that. We directly show that if you would look at forecast provisions of professional forecasters, the slope factor is successful in actually predicting forecast provisions, which seems to be consistent with the idea that the slope factor contains information about future interest rate changes. Okay, so what is our data and sample period looking like? Fed funds futures we get from 1988 until now, if you want to. We look at actually weekly changes, and actually if you would just look at the data, the week-to-week changes for which you have the lowest number of missing observations due to holidays, Christmas, New Year's, and stuff like that. It's actually Wednesday to Wednesday. You can use different days. It's not that important. The futures data is just from the Chicago Mercantile Exchange. And most of our analysis, we focus on the standard event study period, 94 till 2007. You can also extend it, and during the CLB, exploit actually changes in longer dated futures after people were discussing the liftoff, and results are very similar. Okay, so a quick recap on Fed funds futures. So Fed funds futures trade on the Chicago Mercantile Exchange to settle on the effective Fed funds rate during the month. So let's imagine for a second we had a Fed funds an FOMC meeting during the month over which our short-dated future actually settles. Then we could actually write, if this is now the Fed funds futures implied short rate, just as a simple weighted average the rate that is currently prevailing plus what the market is expecting. The weights is just a fraction of the month over which those rates are prevailing, and then potentially there might also be a tiny risk premium, order of magnitude maybe 1 to 3 basis points. Monica Piazzesi and I think it's with Eric Swanson, they argue it pretty much varies at business cycle frequency. So if you look at weekly changes, consistent with what the event-side literature is doing, we completely ignore changes in that animal. So now let's actually briefly just look at what comes out if you would regress the weekly change from Wednesday this week to Wednesday last week of the 3-month futures. On the 1-month future, you see a slope of roughly 1.18 or so. And crucially for us, you see actually that about a third of the variation in the 3-month future is not explained by variation in the 1-month future. You see, so it's only an R-square of 67%. Let me just graphically show you how our slope factor looks like. So it's a regression residual, so it looks actually pretty white noise in the top panel. In the middle panel, you see the change in the 1-month Fed funds future, in the bottom panel, the change in the 3-month Fed funds future. Of course, by construction, slope is orthogonal to the middle panel, and you see in the data a pretty high correlation between our slope and the change in the 3-month future. Now, let me just actually tell you, well, you know, based on analysis, we look at full sample estimate. If you do a rolling estimation or an expanding window estimation, your loading of the 3-month future on the change in the 1-month future would actually be pretty constant over time. And actually this motivated us to look at, let's call it maybe a, I don't know, a simple difference in differences slope factor. So effectively we saw earlier that the loading is pretty close to 1. So what you could do is just say, well, let's impose a loading of 1. The nice thing of doing it this way, on the one hand, it contains a simple, nice economic intuition, what we are capturing. And on the other hand, actually, you don't have to worry at all about generated regressors. So if you lose the simple difference in differences slope, all I'm showing you today is pretty much exactly identical. So if you actually now impose a beta of 1, so what are we capturing? It's now the change in my expectations of the 3-month futures next week relative to the 1-month futures next week, relative to this change in expectations this week. So a way to think about that, that's why we call it telling us speed about future policy tightening and loosening. So it tells me how much do I update my expectations about long run rate relative to short run rate this week, relative to my expectations last week. So that's effectively why you can think about slope as signaling information about policy tightening and loosening. So now what we are doing is we say, well, take actually weekly excess return of the CRISP value weighted index on the left-hand side, starting end of Wednesday next week to Wednesday in 2 weeks, and regress it on the slope from Wednesday this week to Wednesday next week. A couple of other things that could possibly predict weekly stock returns, and see whether there's some association in the slope factor and whether it's able to predict future expected excess return of the CRISP value weighted index. You might actually not really necessarily want to look at contemporaneous changes. The nice feature of looking at high frequency event window, you can be pretty sure that nothing else happens. But if you look at weekly changes, of course it's pretty plausible that maybe there are bad news about the economy, unemployment expectations go up. This would lead to maybe us to update our expectations about the speed of loosening, and then also, however, the stock market be a claim of accurate future dividends might actually drop, and so ultimately you could not really interpret any association contemporaneously. There's also evidence by Rigobon and Sack which would suggest that maybe even actually the stock market going up might actually lead the Fed to tighten within the week, so therefore we actually want to look at this predictive regression. And then we also know from Campbell-McKinley that weekly returns are mildly autocorrelated, so in all of our specifications we've directly lagged weekly returns in there. What you see now in column 1 here is that higher than expectations about faster policy tightening lead to a drop in next week's stock return. So in terms of economic magnitude, if you would want to interpret this coefficient, so 1 standard deviation increase in slope leads to a drop which corresponds to about 1.5 times of the weekly average return and about 14% of the weekly standard deviation. You see actually the R-square is 2.6%, it's pretty sizable for weekly predictive regressions. If you would exclude the lagged return, this would be like 2.2%. So you see that most of this explanatory power comes from the fact that the speed of tightening and loosening seems to contain information for next week's stock return. Then, of course, you're always concerned that you want to make all potential referees happy, so add all possible explanatory variables people have proposed actually to predict return, the dividend price ratio, the VIX and stuff like that, everything that is available at sufficiently high frequency, added as covariates in there, and you see actually that really nothing is going on to our more coefficient of interest over here, so it's still pretty economically sizable, the same magnitude and the same statistical significance. Then, of course, we know that in our very period, starting in '94, thanks to work by Emanuel and David Luca and Savo and Wilson, that actually monetary policy seems really, really special in the sense that if you would only look at the 8 days during which actually the FOMC makes the target rate decisions, you can explain about maybe 60 to 80 or even more % of the realized equity premium during that period. Now, of course, it could be the case that even though we look at actually all weeks throughout the year, maybe all that is happening, we are recapturing those as 8 specific weeks, and then it's not super clear what we actually would learn from this exercise. So what we now actually want to do, and this is maybe just a crude way, but we thought it's maybe the most convincing one, let's actually just exclude weeks during which the FOMC makes decisions. In the first set of weeks, 8 weeks we're exclude all weeks during which there is an FOMC meeting during the week over which we measure the stock returns. The second one is exclude all weeks during weeks that we had an FOMC meeting when you actually measure the slope factor. And the final exercise, exclude all 16 weeks when the FOMC meeting happened either during the slope week or during the return week. Independent of how you do that, you see actually that your main coefficient of interest is still pretty similar. You lose about a third or so of the observation in the last column, so a little bit less statistical power, but economically still pretty similar. So it looks like it's not contained in meeting weeks. That's possibly already a good sign. Then else actually, we argue that this slope factor tells me something about the speed of tightening or loosening of policy. So let's actually see whether indeed actually the slope factor can predict future changes in interest rates. So now what we simply want to do is look at exposed realized changes in Fed funds target rate and see whether the slope factor today can predict those exposed realized changes. Of course, the whole motivation that we said earlier, we want to orthogonalize things, is because there's a strong level effect. When you have an increase next month, this will also, of course, lead to an increase in 2 months and 3 months. So what we want to do, we always want to directly orthogonalize then with respect to the change in the 1 month Fed fund, or 1 month ahead Fed funds rate. So effectively, look at the end of the slope factor when we measure it, and then from that day, go 4 weeks out, and that's a 1 month change, 8 weeks out, and so on. Those are all the changes we are looking at. So 1 month's change, you see actually that a higher slope factor predicts positive changes going forward. 2 months change orthogonalized with respect to the 1 month's change. You almost see coefficient of 1, so it has a very strong predictive power here. And then the last column, so remember, unfortunately, our what we call short, long-dated futures are only 3 month futures, so at some point actually this predictive power vanishes and is actually insignificant going forward. Now, another thing actually, what we have in mind, what might be going on in the data, so we want to later on argue that it's actually communication from the Fed through speeches and testimonies that affects market expectations about the path of future changes in interest rates. So if this is the case, that it's indeed the Fed trying to effectively, through speeches, guide the market, then we should expect that whenever you see a change in the slope, that this can actually predict forecast revisions of professional forecasters. So what we are doing now, we use actually the blue chip financial forecast for the Fed funds rate, 1 quarter, 3 quarter, 4 quarter, and so on out, and then we want to see whether now the slope factor can predict forecast revisions. So if you read the handbook of the blue chip financial forecast, they argue that they typically would get submitted, their forecast by the participants in the last week of the previous month. So now what we are doing is we construct a cumulative slope factor in the first 3 weeks of the previous month and see whether this cumulative slope factor of the first 3 weeks in the previous month can now predict forecast revisions from 2 months ago to last month, always measured in the last week of that respective month. It's truly out of sample in that respect, there's no overlap, and now let's see actually what's going on. So if you would just naively look at the forecast revisions over the next 3 quarters, it would actually look like this slope factor had super strong predictive power for forecast revisions, but the same as is realized in actually realized changes. Of course, also forecast revisions are very sticky. They have this level effect. So once you orthogonalize to the forecast revision in the 1 quarter out Fed funds rate, you see actually that it's effectively that over the next 3 months, actually the slope factor has a strong predictive power for forecast revisions over that period of Fed funds rate. So now let's actually drill into the mechanism. What is now driving variation in this slope factor? And here, I want to provide you a very carefully handcrafted, hand-picked example, which fits well our story, and then hopefully we can generalize that. So this is now just a quote from Alan Greenspan during a speech at the Community Bankers Association or so in Las Vegas. I don't think he was gambling before and hope he was not drunk, but he said, still in an economy that has already lost some momentum, one must remain alert to the possibility that greater caution or weakening of asset prices in financial markets could signal or precipitate an excessive softening in household and business spending. So this is what he said. Let's actually see how people interpreted what he said. So the first way to look at it, let's actually look just at our slope factor. Slope factor is in the top 2% of the realization, so it's largely negative. So that's an extreme slope factor in our observation. And then in the following week, you saw a large positive return. So, it would somewhat nicely fit our story. But let's actually see how the media interpreted it. So if you would look at a quote in the Washington Post by a gentleman from Goldman Sachs, he was saying that I don't think it's actually quite suggesting that they're ready to cut rates, but it seems certain to me that after the next meeting, policymakers might shift away and blah, blah, blah. So anyways, so it looks like that those type of speeches might actually indeed be helpful and convey information about the speed of future tightening and loosening. And so now what we want to do is effectively take all speeches and testimonies of all members of the FOMC that we can download from the Federal Reserve webpage and just do a very simple linguistic analysis, try to see actually whether maybe part of this movement, the slope factor, could be rationalized by speeches and the hawkishness and dovishness of those speeches. And so in particular, what we do is a simple, what's called a search and count mechanism or algorithm. Take a pre-specified word list and just simply count the number of times those word combinations show up in text. Some of them you classify as hawkish, others you classify as storkish, and then actually see whether maybe just the number of occurrences or what people call this net index, so it's just the relative occurrence of hawks minus dove, has predictive power for this or is correlated. This is contemporaneous correlations. Take all speeches that occur during the week of the slope factor and see whether the content of those speeches correlates with this slope factor. So what we are doing here, so this is an overview, doves and hawks. So this is, employment fell, boost aggregate demand. Those are more dovish type of word combinations, 2 grams to be precise, versus asset price rise, house price rise, higher interest rates. Those type of word combinations might actually signal a tighter stand or faster tightening of policy going forward. We have actually all the combinations of words in our appendix in case you're interested, and also the classification of individual speeches. And so if you now just actually correlate contemporaneously the slope to the index or separately to hawks and doves, you see that a positive index is positively correlated with a positive slope. So more hawkish terms seem to predict faster policy tightening. Instead, if you would split it out, more hawks positively correlated, doves negatively correlated. And of course, you could say so far we looked at all speeches, but very similar to dinner at night, lots of people are chatting and talking, but no one listens to what I might have to say. Instead, when Professor Gorodnichenko opens his mouth, everyone listens to what he has to say. A different way of saying that, now you have Janet Yellen who says something, people might listen to her, or Jay Powell. Instead, no one might listen to other members of the FOMC, or maybe differently. So it could be the case that the media tends to focus more on the chair or the vice chair relative to other members of the FOMC, so we cannot disentangle those two alternatives. What we could do in the last 2 columns, we now condition on speeches by the chair and vice chair, and only look at the weeks where we have at least one classification. And actually, if you do that, you see that now actually in weeks where you indeed actually have meaningful information coming out, you can explain up to 12% of this regression residual, which we thought actually it's quite pretty sizable. So the last part, so far we only looked at correlations, some predictive regressions, but could either be the case that both the FOMC and the financial markets get macro news, update their expectations, and that's what's going on. Or it could also be the case that maybe the FOMC changes their interpretation, readings of macro news, and then communicates that to the market, and that's what's going on. This is only suggestive what we are doing now, but let's actually see, once we condition on macro surprises, whether you still see this predictive power of the slope for financial markets. So what I'm showing now is just look at all macro surprises about CPI, unemployment rate, GDP growth, industrial production, capacity utilization, all of those things coming from Haver Analytics. I think it's 13 or 14 series in total. And actually just say, now let's actually regress our stock return on the slope factor and all of those macro surprises. And then if you add all of those macro surprises, which hopefully capture as much you can think of that could be relevant for stock returns and the slope factor, let's see whether actually slope still contains meaningful information for next week's stock returns. So, there we are. So, okay, perfect. So what you see now in column 1, this is just, Taylor rule is a pretty accurate description of monetary policy during our period. Let's look at GDP surprises, column 1, or CPI inflation surprises in column 2. You actually see that those two enter, if anything, marginally significant only, but crucially for us, if you recall our point estimates from earlier, pretty much no impact whatsoever, and also pretty much no impact on increasing explanatory power of the model. In column 3, we did both of them jointly, also not really anything going on. And then actually in the penultimate column, in column 4, we had all of those 13 or 14 surprises jointly. And again, you see that none of them actually jointly or individually can drive out variation coming from slope for predicting next week's stock return. That should be clear. We are not arguing that slope is not correlated with macro surprises. I think that's almost by construction, you would hope, if the slope factor captures meaningful information, but it is not correlated with a part that's actually predicting stock return. So what you see in the last column, put slope on the left-hand side and regressed in all of the macro surprises. So these are all 14 surprises. You can see that you explain about 9% of the variation in slope, but it's not the part of the variation that is correlated with next week's stock return. So just actually, I mentioned it at the beginning, you can make some assumption on preferences and say, let's actually look at the Sharpe ratio a buy and hold investor would realize relative to a Sharpe ratio an investor could realize when trading purely out of sample on the predictive information in slope. This is just one way to get some idea in terms of economic relevance and magnitudes. If you do this back on the envelope calculation, you get a number that you would increase your Sharpe ratio by about 20 percentage points, which is, I would say, economically meaningful. So let me just wrap up. So there is this quote by someone we might all know that monetary policy is at the end of the day 98% talk and only 2% action. This actually fits nicely with the whole theme of the conference, the previous paper. I think actually what we still have to, however, understand better, and there's now growing evidence, thanks to great work by Michał, Michał Lamla, Carola, Michael Mahon, and some of the work Yuri, Oli, and I have been doing, that it looks like communication can shape people's expectations, but we still don't know through which channels people can be reached. So if you force them to read text, they react to it, but in reality, most people actually, unfortunately, don't read the newspaper. How do we then reach them? So those are open questions I think we still have to figure out, but I think overall what I wanted to do instead in the paper today, so I'm going a little bit off tangent, was to understand whether a slope factor that we argue capture the speed of tightening and loosening actually contains useful information for predicting stock returns. There seems to be evidence, and it seems to be consistent with the idea that part of news about policy is not only coming out on those tight half-hour windows around scheduled meetings, but possibly throughout the year, just simply by using speeches and testimonies and communicating, in our case, with financial market participants. Thank you.
Thank you, Michael. So I would like to invite discussant Emanuel Mönch from the Deutsche Bundesbank, please.
Thank you very much. Before I start, I would like to congratulate the organizers for putting together a very nice, coherent program, very nice conference. Would like to thank the National Bank of Ukraine for the hospitality. It's a great pleasure to be here and to discuss this very interesting paper. I'm one of the central bankers, so there is a disclaimer on the slides. Let me jump right in. As usual, Michael did a great job of summarizing all the results in the paper. So I will spend just a little bit of time on a high-level summary to remind you, in case you already forgot while you were checking or you were checking your emails. And then I have essentially two comments or questions, and they are: when do Fed funds futures predict the stock market, and which speeches or which communication is actually affecting those changes in rate expectations that do seem to predict the stock market? And then I'll wrap up. Okay, summary of the paper and related literature. So Michael and his co-author argue that, or they construct a slope factor from Fed funds futures measuring changes in expected policy paths 1 to 3 months out. They show that the slope factor predicts stock returns at the weekly frequency. In particular, they find that the faster monetary policy easing predicts higher excess returns and vice versa. Faster monetary policy tightening predicts lower excess returns in the stock market the week after. They show that the slope factor predicts changes in future interest rates and forecast revisions of professional forecasters. So there's some information in this sort of measure coming from futures markets about actual revisions of forecasters of policy rates. And they then move on to show that the tone of speeches by the FOMC chair and vice chair, as well as macro news, correlate with the slope factor. But the latter, the sort of the effects of macro news on the slope factor cannot explain the return predictability. So there's something else in the slope factor beyond sort of incorporating changes about the, or forecast revisions about the macroeconomy that seems to be predicting stock returns. The authors conclude that communication about monetary policy affects asset prices throughout the year and not only at FOMC meetings, and that's very interesting and jives well with the sort of spirit of this conference. Let me do a very brief selective literature on review on the Fed and the stock market. Michael already mentioned a couple of papers. Bernanke and Kuttner have a very famous paper in the JF showing that the stock market reacts strongly to monetary policy announcements or surprises, measured exactly as federal funds rate futures innovations, but on FOMC announcement days. And that has triggered a lot of research into the relationship between monetary policy news and the stock market. I have contributed with a paper showing that actually 80% of the cumulative return in the S&P 500 between 1994 and 2011 have been earned in the 24 hours before scheduled FOMC announcements. And that's true also for other developed stock markets. So there seems to be a large proportion in stock returns around FOMC announcement days that's actually earned ahead of the announcement and not after the announcement. And interestingly, we found that this pre-announcement return is independent of the sign of the policy surprise. So that basically there is a large run-up in stock prices ahead of FOMC announcements, no matter what the FOMC decides basically or announces at 2:15 p.m. When they usually put out their statement. We also found that there was no such pre-announcement returns in bonds. And there's a long literature now trying to understand what's going on with the stock market around FOMC announcement days. The two authors have a related paper that shows that the stock markets actually starts drifting up about 25 days before the Fed announces surprise easings, but not before their surprise tightening. So this is a very active literature that Michael has contributed to. And the interesting thing, or where this paper comes in and what this paper adds, is that while the prior literature is mainly focused on the stock market around FOMC announcement days, Andreas and Michael show that actually monetary policy is related to news, or monetary policy news affects stock markets also outside of FOMC meeting weeks, and that makes it very, very interesting. And they link the predictive power of the Fed funds futures changes for the stock market to monetary policy communication via speeches. Let me just review briefly the main regression. They run a very simple regression of weekly excess returns on the stock market on this constructed slope factor and some controls. 1 week lagged slope factor and controls, where the slope is the residual in a simple regression of the change, weekly change in the 3-month Federal Funds futures contract on the weekly change in the 1-month Federal Funds futures contract. And this slope residual, as Michael showed, explains about a third of the variation in changes, in the weekly changes in the 3-month Federal Funds futures. As you can see, the coefficient is fairly close to 1, so they also construct a sort of a non-regression based version of the slope factor, which is just a simple difference between these weekly changes in the 3-month and the 1-month Federal Funds future, and they show that the results regressing the stock returns on those two measures are fairly similar. They use weekly data from 1994 to 2007. They, interestingly, going back to the work of Bernanke-Kuttner and also my own paper on FOMC announcement days and stock returns around those FOMC announcements, they find that this predictability of the slope factor for stock returns is not actually coming about through the weeks where there are announcements, but is equally strong in weeks where there's no FOMC announcement. So there must be something going on in the intermeeting period where the stock market is basically reacting to news about the future path of policy rates. They argue that this, what's going on is that actually the Fed is releasing information to markets continuously, via speeches, for example. And so they construct this index, as Michael explained very well, of basically hawkish and dovish terms in FOMC member speeches, or should be more precise, is actually board of governors, governors from the Fed board speeches. And then they basically show that this index predicts the slope factor. So basically, when speeches are more or perceived as more hawkish or dovish by this simple index, then the futures markets reacts. Futures traders expect a faster tightening of policy, and then that leads to lower stock returns going forward. Okay. If you just look at this sort of third column here, focusing only on speeches by the FOMC chair and the vice chair of the Board of Government, and you basically relate the tone of the speeches, here measured by this hawkish dovish index, to the slope factor, you see there's a positive relationship. So many speeches are quite hawkish. The slope factor tends to be positive after those speeches, and the slope factor seems to be a little lower when there's dovish speeches, okay? But there's also a lot of speeches that are actually fairly neutral, I would say. Okay, comments. The predictive power of the slope factor appears to be quite stable over time, but of course the stock market has seen quite drastic sort of developments over this period. So I was going to look a little bit more at when exactly is the Fed funds futures markets predicting stock returns. For those of you who don't follow this literature, there's actually a very active debate in finance about whether anything can predict stock returns. There's papers being published with titles such as Stock Return Predictability, Does It Exist? And I think it's fair to say that the literature isn't settled on whether you can predict stock returns. So whenever you see something predict stock returns, some people get very excited, others get very skeptical. A fairly important contribution to this literature was made by Goyal and Welch in an RFS paper 2008, who basically showed that over very long samples, all the standard predictor variables have a hard time beating the simple rolling mean of the stock return in a consistent fashion. Some variables work sometimes, others work other times, but there's no single variable that really consistently predicts stock returns over and above the information already contained in past stock returns. So and what they do is actually they develop a very simple yet powerful sort of metric to assess the predictability of a predictor variable for the stock market, and I will just apply their sort of method. So what they do is they regress stock returns on some predictor variables, and back out residuals from this regression, so that's my epsilon t plus 1 doing this for the slope factor, and then they compare this with a naive benchmark where the return is basically assumed to be a constant plus some noise. And then they plot the sum of squared differences or the sum of differences of squared residuals of those two variables, those two models. So if a predictor variable works particularly well, then you would expect the sum to be going up over time because the residuals from the model using this predictor will be smaller than the residuals coming from the model that only has past stock returns in it, okay? Michael was kind enough to share his data with me, and so I was basically applying the simple Goyal-Welch test and plotting here the in-sample and also recursive out-of-sample forecast results according to the simple metric, which basically shows the sum of squared differences in forecast residuals, sum of differences of squared forecast residuals, I should say. And what you can see is that basically all the predictive, first of all, you see that these lines go up. So yes, the slope factor does predict the stock market, but it pretty much adds only in this period in between 1999 and 2001. That's really where both in the out-of-sample and in the in-sample prediction, the model kicks in. So the Fed funds futures market was particularly informative about stock returns in this particular period. Now, if I go back to the in-sample regressions and show you sort of how the coefficients and also the t-statistics change for different periods of time, you'll see that basically in the full sample, the slope factor is highly significant. If you end the sample in 1998, the slope factor loses its significance. Here, by the way, I'm focusing on the simple difference factor instead of the estimated slope factor, so I don't have to do bootstraps. But the results are basically very similar to the estimated slope factor. You see that the coefficient drops quite a bit, loses significance. If you focus on the period after 2001, you see that again the coefficient is quite a bit smaller and loses its significance. If you look at the sort of joint sample from 94 to 2007, taking out the period 99 to 2001, the coefficient is quite a bit smaller, it's not very significant. If, however, you look at this very short 3-year period from 1999 to 2001, the slope factor, the coefficient actually increases tenfold and is highly significant. So yes, the slope factor does predict the stock returns, but it seems to be really doing it only in this 3-year period mainly. Okay, and so what was going on in this 3-year period, we need to understand to assess why this factor is predicting the stock market. Of course, you all remember that this is a period where there was a dot-com bubble and bust. There was also a short recession in 2001, and of course there was 9/11. So many things happened around this period here. I'm just plotting the Nasdaq Composite Index going up very sharply, the Fed tightening. Then the market drops, the Fed keeps rates actually fairly steady, and then when there's sort of an impending recession, they ease the Fed funds rate very sharply, okay? And you see this also in the broader stock market here. I showed the S&P 500, similar things going on. So when stock markets start falling or tanking, the Fed stays put for some time, but at some point it really eases very, very sharply. Now, the argument in the paper, and I think it's very convincing to me, is that Fed funds or Federal Reserve communication drives movements in this slope factor changes in market expectations of future tightenings and easings. So let's look at the relationship between these speeches over this particular period, 1999 to 2001. And so I'm plotting again the slope factor against these hawkish and dovish index for these speeches, but only over this 3-year period, focusing only on, again, the speeches by the FOMC chair and vice chair. And what you see is that basically there's 2 speeches in this period that sort of stand out in this relationship, where the slope factor and the net hawkish dovish index are particularly large. And so let's look at these speeches and what the policymakers were telling us then. Alan Greenspan, it's a different speech than the one that Michael showed us. Alan Greenspan, April 5, 2000, talked on technological innovation and the economy. And he was basically going over what the new economy meant for the stock market. And then he said that this does not imply that the most straightforward way to restore balance in financial and product markets is for monetary policy to target asset price levels. Leaving aside the deeper question of whether asset price targeting is an appropriate governmental function, there's little, if anything, evidence that monetary policy aimed at achieving that goal would be successful. The second important speech in that sort of short period of time was made or given by Richard Ferguson, Vice Chair of the Board of Governors, and he was saying that since in the long run there's no trade-off between unemployment and inflation, we know that keeping inflation low and stable and maintaining an obvious stance of vigilance vis-à-vis inflation so that inflation expectations are also relatively low is the main value that the central bank can add to this equation. So I personally interpret this speech as not very hawkish, and this speech is a little bit more hawkish. So I think it's sort of not so clear how hawkish these are by just reading the speeches as an economist. So let's look at the stock market. Actually, around the first speech, on the day of the speech, actually, the stock market retracted a little bit, and then the 2 days after the speech, the stock market increased again. The second speech by Ferguson, the stock market tanked on the day of the speech, and went down a little bit, and then went down a little further the day after, and then again recovered some of the losses on 2 days later. So the stock market itself doesn't seem to have strongly responded to those speeches. And I think it would be useful to show that the tone of the Fed speeches and the commentary in the press, and you showed some of these examples, directly moves the Fed funds futures and the stock market, especially in this particular period. So let me wrap up. I think this is a very interesting paper that documents the changes in near-term policy rate expectations predict stock returns. The paper links these changes in policy rate expectations to the tone of Fed governor speeches, and I think that's, I clearly think there is information revealed in these speeches. The predictability, however, seems to be limited to the sample 1999 to 2001, and during that period, mainly two speeches seem to be driving the correlation between tone and Fed funds futures. So I think more conclusive evidence would be welcome regarding the impact of speeches and other monetary policy communication on the stock market. And overall, though, I think it's a very nice paper. I learned a lot reading it, and I recommend everyone to take a look. And thanks again.
Thank you very much. So we will give you a few minutes to respond.
Yeah, thank you. So, Emanuel, first of all, thanks a lot for a very thorough and insightful discussion as usual, what I was expecting. So, I think actually I'm very excited to see that out of sample, the predictive power is actually not negative, because as Emanuel said, if you would look at this Goyal-Welch evidence, you lose any standard predictive regression, dividend price ratio, slope of the term structure, K by Letter and Ludwigsen. If you look out of sample, it's all drifting always to the negative domain. So I was actually a bit scared to see a graph like that. So the fact that it's actually pretty close to zero most of the time, and actually at the end is pretty positive, is actually, I think, good news for us. I have to say, actually, it took me a couple of minutes to understand that because we were using Nui West and NW. I typically use NW for Nui West and not for Neuhel Weber. So I was a bit confused, but I figured out what you meant at some point. Yes, I think actually, I couldn't agree more with all of the things Emanuel said, in the sense that more evidence is always needed, and I think we can do more. Mm-hmm.
Yes, we have time for 2 questions. Okay, so please here. Do we have somebody with mic?
I'll shout. Okay. There's usually a blackout week before FOMC meetings. I would love to see you run your regressions during the blackout week. If you get the same result, something's wrong.
And I'm very grateful that you asked those questions. We did that. If you look at first the classification, you don't see the Hawk-Dove index moving in those actually blackout weeks, and there's also nothing there. So that's, I think, this was for us also a little bit of a smell test to see whether we are just picking up some random noise due to other reasons. Then that's actually, I should have stressed that, yes, totally.
Very interesting paper. I was a bit surprised with the choice of both FF1 and FF3 in constructing a slope measure. FF3 seems very short, and like a 4th euro-dollar futures contract, that goes back to the early 80s. And that is a more standard long rate in these slope things. And FF1, if I've understood it correctly, that means the current month futures. And unless you're in a month with an FOMC meeting before the FOMC meeting, that should be very close to zero. So I would instead take like the expectation after the next meeting.
Yes, so I think we were discussing at some point whether we should go to Eurodollar futures. And I think, as you said, it's the reason why. So initially we said, well, let's actually stick to the direct policy instrument of the FOMC and this tradition of using Fed funds futures. And then RayFed, I think it's in one of his papers, discusses extensively the liquidity of those contracts and argues that until I think 99, nothing longer than the 3-month Fed funds futures was liquid. That's why we contained ourselves to that one. But I think, yes, we should actually just maybe do what you said and use Eurodollar futures with a longer maturity. I'm sure many in the room actually know that better than I do, but I think even to remember that until 98 or so, the longest traded future was a 6-month future, and then only after that we had a 9-month future, and now actually have pretty much way longer maturities.
Okay, unfortunately we have to stop here. I'm sure that we can continue discussion at the coffee break. So I would like to thank our speakers and especially to Discussants for comprehensive reviews, and see you in 20 minutes back here for the next session.